Hello, welcome back. Today we will talk about the reward to risk ratio, and we will expand on the reward to risk ratio a little bit and dig into more advanced features and concepts of this metric. So let's start first. To recap, what is the reward to risk ratio? It compares the potential profit and the potential loss for a trade and then builds a ratio. What does it mean for you? The most important thing about the reward to risk ratio is that it gives you a threshold for your trades, and we will explore that later, how you can use the specific reward to risk ratio and also your win rate to filter your trades to get a better expectancy and to boost your trading performance. And as a consequence of this, you can use the reward to risk ratio and the filter to avoid low expectancy trades, to smooth out your equity graph, and to reduce overall account volatility. So let's start with the threshold. So once you have your reward to risk ratio, you can calculate the required win rate you need for that trade. So although this looks complicated now in this formula, it will become very easy, and we will just set in the numbers and then you will see what this is all about. So let's start here. If we have a trade with a reward to risk ratio of 1:1, it means that the stop loss and the take profit have the same size. So your reward to risk ratio is 1. Once we set in 1 here for the reward to risk ratio, then you can see already we have 1 divided by 2. And of course, this is 0.5 and 50%. So this means if you have a trade with a reward to risk ratio of 1:1, your trading performance needs to be at least 50% win rate or higher, because one winner equals one loser, and for every losing trade you need at least one winning trade to offset the losses. And once your win rate is above 50%, then you can trade comfortably with a reward to risk ratio of 1. So let's do another example. If we take the reward to risk ratio of 2:1, it means that the winners have twice the size of the losers. And we can already see that for every 2 losses, we need 1 winning trade to offset the loss. And when we take the 2 from this reward to risk ratio, we swap it here for this number. Then we have 1 divided by 3, and this is 0.33. And you need a win rate of 33% then to trade profitably with a reward to risk ratio of 2:1. Let's do another one together. For a reward to risk ratio of 3:1, it means that you can have 3 losing trades and only 1 winning trade will then offset the losses. So out of every 4 trades, you need 1 winner and you can have 3 losses and you will still end up break even. So if we take the 3 here from this one, we put it in here, then we have 1 divided by 4 and this is 0.25. And as long as your win rate is above 25%, it means that you can trade profitably with a reward to risk ratio of 3:1. So you can already see that often, if traders understand this very basic relationship, is that they don't need very high reward to risk ratio if the win rate is fairly good, or if they have a low win rate, then they just go with a higher reward to risk ratio. Here I summarized it again for you in this graph. You can see here the required win rate on the left axis and the reward to risk ratio on the bottom. So you can see the higher the reward to risk ratio is, the smaller your win rate has to be. So now let's explore how this can help your trading a little bit more. Every trade has 3 variables. The first is the reward to risk ratio, how big your potential profit is compared to your potential loss. The second one is your overall win rate for the setup or the trade. This you will get from your historic performance. If you have a trading journal, then the trading journal will also tell you your win rate. And the third component of a trade is the position size. It means how much you risk per trade and how much you can lose. So obviously there are differences between the 3 variables and you cannot control your win rate. You don't have a lot of influence on your win rate. Of course, you can tweak it and become better over time, but there's nothing on a trade to trade basis that can make a huge difference on your win rate, so you cannot control it. On the other hand, the position size you can control. You have total control over how much you risk per trade, how big your loss is going to be if you set your stop loss correct, and then also size the amount of contracts you have to buy for the position. The reward to risk ratio stands a little bit between the two. You don't have full control over it, although you can set a high reward to risk ratio, but then often it becomes unrealistic. That price will actually reach it. But on the other hand, you have control over it in so far that you can avoid trades with a low reward to risk ratio and skip those low reward to risk ratio trades and only choose the trades where you have a good and big enough reward to risk ratio based on the calculation that I showed you previously. So now let's put this in together, how the three variables impact your equity growth and your account balance. So the win rate means the distribution between your wins and losses. The reward to risk ratio shows how fast winners can offset your losing trades. And the position size determines the size of your losses and your winning trades. If this sounds too abstract, don't worry, we will soon get into a very practical example and explore a few different scenarios, and then you will see exactly how this plays out. So let's do another statistics lesson, and we will cover expectancy, which is a very important metric, and then we will get into the practical part. So expectancy means how much each individual trade is worth for you based on your performance and your historical win rate. So let's get into the formula, and then it will become very obvious once we get to the example. So you can see the formula uses win rate, position size, reward to risk ratio. The loss rate is just the opposite of the win rate. All the three variables we already have based on the previous layer. And you can see that only we need those three variables to see and to judge very nicely your trading performance. So let's explore an example with three actual figures. Let's say we have a win rate of 60%, our position size is 2%, and the average reward to risk ratio is 2.2 to 1. If we now take those three variables, we put them in here for those values here in the formula, then you can see that we get an expectancy of 1.6%. This means that over the long term, each trade, if you take the same trade over and over again, based on the expectancy, each trade will give you a 1.6% return. Of course, you will lose some trades, but this is a statistical formula and it's a statistical law that based on your historical win rate, each trade will over the long term, let's say after 50 or 100 trades, you can very nicely see that each trade will give you a 1.6% return. A general rule of the expectancy is that the lower the value here is, the more swings you usually have in your account balance, especially if your position size is also very large. So this is something to be aware of. Don't let the expectancy be too low, and especially if your position size is very high as well, then this will create major account fluctuations in your account. So let's be a bit more practical and explore a few different scenarios with this Edgewonk account simulator and the Edgewonk trading journal. So you can see we have the account simulation here in the middle. The further away the individual graphs are, it means the more account volatility you can expect, and also the way the individual graphs shape up, it can show you a lot about the account volatility. Here we can see we have a win rate of 60%, the reward to risk ratio is 1.5, and the risk in percent, which is the position size, is 3.5% per trade. You can see if we start a simulation, overall the graphs are all going up. You have modest volatility, a few fluctuations, but it's looking very good so far, nothing too major. And now let's see what happens once we start changing the variables and how they impact account growth. So we kept the reward to risk ratio constant, we just increased the position size and the risk to 5%. And you can now see that although the account growth is faster, the graphs are further apart from each other, which means that you can expect more swings, more account volatility, and overall a more unstable growth. Now let's do another change and see how a different reward to risk ratio impacts trading performance. As we learned in the previous lesson, with a reward to risk ratio of 1.25, you only need a win rate of 44% or higher to trade profitably. Here we have a 60% win rate, so we are way above this threshold, but let's see what happens now after we have changed the reward to risk ratio. The risk is constant, and you can already see that the fluctuation is much higher now. You have a lot more that go all the way up and a lot more graphs that are further at the bottom. Overall, you have a lot of volatility now just with this small change in the reward to risk ratio. I reduced the reward to risk ratio now to 1.1, and now let's see what happens. You can see the account volatility has increased even more now, even though the change was very small. So you can see how the three variables impact your account volatility and account growth. And although this all looks very good, you're always moving to the upper right hand corner of your account graph, which is the optimal scenario. The problem is here in the middle. And once you are experiencing a period of slow growth, or maybe even a period of extensive drawdowns, then often traders start doubt themselves, their emotions get in the way, and then they change their trading approach, they increase the risk, they do something different, and then what happens is they cannot reach the optimal growth, but then the account graph just drops off and goes sideways, and they will never be able to reach this optimal scenario. So as I said, use the reward to risk ratio as a filter in your trading. Always try to keep the reward to risk ratio high. Skip the trades that don't match or that have a very low reward to risk ratio. Even though they are above the threshold, it does not automatically mean you should take the trades. You have to audit your emotions. How well can you deal with drawdowns? And then you should pick a reward to risk ratio that offers a good offset and a good expectancy, and at the same time stay realistic. Don't be over optimistic. Don't just set your take profits too far away to get into a trade. Always assess what is reasonable, how far could price go, and then you will see a better account growth and a more stable account growth as well.